Hello and welcome. Today we're going to go ahead and start with a simple topic of depreciation. So first I just wanted to make clear of what depreciation actually is. Depreciation is a process of allocating the cost of a plant asset to expense in the accounting periods benefiting from its use. So what that really means is, let's say we have a plant asset. We want to make sure that we're allocating how much we're benefiting from it by using it over the certain years. So let's first think about what is a plant asset. A plant asset is what? Land, equipment, machines, anything that is tangible. Those are plant assets in your company. So for land, there's an exception. We never depreciate land. So that's something important to know. So moving on, in order to calculate your depreciation, there's one method that I wanted to go over today, and that's the straight line method. In the straight line method, you have a formula, and to calculate annual depreciation, you have to figure out the cost minus your salvage value over the useful life. So the cost is C, right, in this formula here. That's how much you paid for this certain equipment or machinery. The salvage value is the estimated value that an asset will realize upon its sale at the end of its useful life, okay? And then the useful life is simple, the useful life. You know, how long are we able to use this certain machinery until it's done, right? Until it's done so. No longer able to use it. So now that we know what depreciation is, and we know that there's one method that we can use, there's also different types of methods. There's, units of production method, there's the declining balance method, but today we're just going to focus on the straight line method, which is the most commonly used method here. I'm going to give you guys an example. The first example says, on December 31st, 2012, equipment was purchased for $50,000. Okay, so we must have purchased some big equipment, right? The equipment has a useful life of 5 years and an estimated salvage value of $5,000. So it's telling me basically we have 5 years to use this, and then once it's done, and like after the 5 years, it's going to be worth $5,000. It wants me to calculate the depreciation expense per year. So going back to the straight line method formula, it tells me annual depreciation is cost minus salvage value over useful life. So my cost here is $50,000. It told me that we purchased it for $50,000. My salvage value was told, the estimated salvage value was $5,000. And the useful life was 5 years. So the equipment had a useful life of 5 years. Now let's go ahead and finish up with the problem. We want to go ahead and put it in our formula. So we did $50,000 minus salvage value of $5,000 over the useful life. So if I do that in my calculator, I would do $50,000 minus $5,000, which is $45,000, divided that by my useful life of how many years? They said 5. So now I calculated my annual depreciation, and it should be $9,000. When you do this, you want to obviously account for it in your accounting periods. You want to make sure you have the correct journal entry. So on December 31st, I'm going to record this. I'm going to record a debit to depreciation expense because technically it's an expense, right? Every year, the depreciation is $9,000. We're using this machinery where it's wearing down $9,000, okay? And then we're going to credit the accumulated depreciation account of $9,000. So that is how you go ahead and you do depreciation. So if we were just to recap of what we went over just now, we learned that depreciation is the process of allocating the cost of a plant asset to expense in the accounting periods benefiting from its use. We understand that plant assets are things that are tangible in our company, such as machinery, equipment, land, buildings. We explored one type of method, which is the straight line method, to determine annual depreciation. We understand that it's cost minus salvage value over useful life. And then we figured out by putting the information in our formula, we came up with an answer of $9,000 and a journal entry to record that expense. Okay, so with that being said, thank you and have a wonderful day.